Good morning, ladies and gentlemen. I'll wait for some of the people in the back to sit down, maybe. Well, thank you, everybody, for joining us this morning on our panel around how to Africanize infrastructure investment. I know that we're running slightly late, so it might be worth maybe if we can invite our expert, James Woodward, who is the, KPMG, the infrastructure expert from KPMG, to the stage for your presentation. Thank you.
Good morning, everyone, and welcome here today for this session. I've been asked to try to summarize everything that's going on in the infrastructure sector in approximately 6 minutes, so we're going to have to dive straight in because there is a lot to try to get through. So first of all, let's just quickly set the scene. You would have seen some of the commentary there in the briefing for this session today, that we have an annual infrastructure need of approximately $170 billion US dollars and a financing gap of approximately 95. Now, the bad news is the last time these figures were done was about 5 years ago, so pre-pandemic. The Africa Development Bank that came up with them is in the process of revising them, and those numbers are both likely expected to go up. The good news, however, is that we've got two major ways which this panel today is going to focus on what options we've got to try to address this issue. So the first piece that we're going to be tackling is around this $2 trillion US dollars equivalent worth of pension fund and sovereign wealth fund capital that sits in local currency within Africa already. So that money is available next to international capital potentially to come into the infrastructure asset class. And then the other piece of information that's very relevant here is that only 10% of the infrastructure project financing that's happening on this continent at the moment is sourcing from private capital, meaning we are still seeing a preference for governments to try to move their projects forwards through utilising their balance sheet. And the question is really whether or not that's sustainable and how we can try to get that number up. So in the context here, if we just look at a few of the key drivers that we're seeing in the market at the moment. So while infrastructure does remain a very strong enabler for economic recovery, and these constrained national budgets are there is an impetus now for governments to look at how can we try to fast track some of these other sources of capital coming into deals. How can we use PPP and similar structures to try to move the market forward. The next piece here I think is quite critical, where everybody that works in this sector knows that the Chinese have a unique way of going about sourcing some of their deals, how they finance some of their deals on the continent. In 2019, the government of China came up with a policy where they were setting their own debt sustainability limits for each of the emerging markets that they are working in. So while this was seen initially as just being perhaps a little bit of rhetoric around sustainable lending, we are starting to see that actually come into force, constraining the ability for Chinese state-owned entities to come in and sole source transactions and move forward at the pace that they were in the past. The next is on the Africa Development Bank's strategic framework for PPPs. This was rolled out in January of this year, and it's got three major elements that will be coming to market quite soon. The first is a capacity building program across the continent. The second is around providing transaction advisory and project preparation facilities that will be standardized across the continent. And the third piece of this is they are looking at infrastructure financing, that while the bank itself is providing approximately 30% of the PPP deals, they have some form of sovereign lending component, if it's viability gap funding or whatever it might be. They're now looking to transform how they participate, and with a specific focus on crowding in local financial institutions into these transactions. So we're expecting to see this be quite a big change in the market. Public sector policy, from government guarantees and local content, there is a consistent push when these projects are new and first of a kind that these government guarantees are absolutely critical to support the lenders. But as we're starting to see portfolios of transactions move forward, these projects are naturally being de-risked, or these programs are being de-risked, And so we are starting to see that a slight watering down of some of these government guarantees, which reduces the contingent liability for governments. And then the local currency investment enablers and infrastructure-specific sovereign wealth fund vehicles. So we are seeing some really interesting enablers happening there. In some countries, we're seeing regulations change that are now allowing pension funds to be able to invest into the infrastructure sector for the first time as an allowable asset class. And then we even have one country, which will remain unnamed today because they haven't announced it yet, are looking to put a minimum amount of compulsory investment into the infrastructure sector that's built up to over time. So trying to force the pension industry in that particular country to get on board with investing in this asset class. And then on the infrastructure-specific sovereign wealth fund vehicles, we can take an example from Nigeria. They've always had the National Infrastructure Fund, a hard currency fund. They're now in the process of mobilizing InfraCorp, which will be their first Naira-based fund, starting with $1 trillion, and then trying to crowd in other institutional investors into that particular fund as they move forward. And then finally, on capacity building on the government and financing sides, we've seen some really interesting steps forward for local financiers starting to understand the project finance deals, but we are still struggling that in any country where we are starting to see the public sector build up skill set in that space, those individuals are poached over to the private sector side and the lending side very quickly. So that's one that we still need to try to move forward. And to round out here, what I wanted to do was just give one project example of where all these elements are coming together. So there is a project in the northeastern region of Kenya. It's on the triangular border between Kenya, Ethiopia, and Somalia. So it is quite a fragile part of the African context. And we have quite a marginalized community living up there in that space. In the wet season, they have no access to get back to the national road network. So there's a real need for providing them with a road project there. So we have a PPP project. It's a 10-year PPP, relatively short, design, build, finance, operate, maintain, availability-based payment mechanism, $200 million capex or so. But what gets very interesting in this project is how we have a Chinese firm partnered with a local firm that has gone out to the market to raise private capital for that deal. So we are seeing Chinese firms now bidding when they were not able to draw on the former sovereign lines that they had, actively participating in these transactions in a competitive fashion, partnering with locals and raising European DFI funds as well. The second point on this is that where we had the local partner unable to raise sufficient capital themselves locally in the market, of finding a solution there with a junior debt bond that was able to be issued, working with the local capital markets authority, structuring a placement into the market, raising that through approaching nearly all the pension funds in the country. 85 of those pension funds came back and wanted to place as part of this debt, and it was 240% oversubscribed, and it was in local currency. So we can see that these kind of transactions, when structured well, and yes, there is credit enhancement sitting behind that, with market education, that we are able to see these local currency participants start to move into this space. And to close off, I'd say the important point that we've got from this is a transaction that has a blended finance structure of DFIs giving hard currency, regional banks giving hard currency, regional banks giving local currency, local banks giving local currency, and now local pension funds coming into this transaction as well. So a true blended finance transaction that's merging hard currency with soft currency. It's merging international investors with local investors as well. And critically, this is a project in such a marginalized area of our continent that if you can manage the risk there, the ability to manage similar risks in other projects seems very much within our grasp. So with that, while that is one example of how we can find solutions in a very exciting project that's moving forward, there are many others. So I'll hand back to Kanika, and with that, looking forward to hearing from our other panelists. Thank you.
Thank you, James Woodward, who is the Head of Transport and Infrastructure at KPMG East Africa. that was a really helpful introduction to the upcoming panel. I am Kanika Seigel. I'm the business editor at the Africa Report, and I'll be your moderator for today, as you can tell. And I'd like to introduce to you the panelists to the stage. So firstly, we have Tarier Badageshin, who is the CEO of ARM Harith. We have Thierry Diot, the chairman and CEO of Meridium. And John Gandolfo, who's the vice president and treasurer at the International Finance Corporation. And last but not least, we have our expert who's coming back, James Woodward, head of transport and infrastructure at KPMG East Africa. So thanks everyone for joining us today on the panel. James, I did want to ask a question relating to the discussion that we just had now, the presentation. Because it feels like, you managed to find an approach that got local banks involved in this interesting infrastructure project. I mean, from, I think, my experience, a lot of local banks seem to be stuck in this cycle of buying government bonds, maybe lending to higher credit companies. So I do wonder, specifically, what do you think needs to happen to get these local banks much more involved in investing in alternative assets?
Thanks, Kanika. So I think the first principle here is, at its most basic level, we've got local currency revenue streams for most of these projects, and trying to just match them at a minimum with the local currency costs that come with developing this project is important, but we should be able to push it even further than there. So there is a real need to find a way to get the local banks to come into these transactions. So I'd say the piece around education, for local banks to really be able to understand what does future cash flow lending look like in a project finance deal, that has to be started from first principles, or you're not going to make it through sort of your credit space. And I think where we've got this Africa Development Bank approach to trying to crowd in, we're going to see a lot of support for that kind of thing coming on board. But I think the other important point is, what's the return for these banks, or even if we look at the pension funds, for instance. In this particular transaction, we were timing the placement of this debt to follow only 2 weeks after one of the blue chip Kenyan companies was going to market to raise a placement as well. And we were still able to come away from that process 244% oversubscribed. So when you get the economics right, you build in credit enhancement, which is, in my view, important for first mover projects, but can be trailed off once you start to get a portfolio working, and match that with these lending groups understanding the economics and the risks of project finance deals, we can pull this off.
John, I think this would be a good point to bring you in, because I think, James talks about this idea of capacity building. I mean, what is the role of the DFIs in that, in terms of capacity building, knowledge sharing, creating this, I guess, holistic product where investors are comfortable to look at infrastructure in Africa?
So I think that we all understand the importance of capital markets and the role that they play in allowing investors and borrowers and so forth to come together, and the development of vibrant capital markets. And I think that DFIs play a very active role in the development of capital markets through the policy space, the overall architecture, the regulatory environment. Through the World Bank Group, we created a group called the JCAP program, Joint Capital Markets Advisory Program, which is a combination of advisory, education, policy work, and also coming in to do what we would call demonstration transactions. And I think that that's a very important component of this, where demonstrating that transactions are possible. And we've been able to make local currency available in 20 plus currencies across the continent, issue local currency bonds in many different markets. And I can continue on what we've been doing on the bank side, but
Yeah. Well, I mean, I guess it'd be good to maybe get the view from the fund managers, right? So around how, in reality, you're seeing the kind of collaboration between the DFIs, the local banks, all of the stakeholders in actually getting these projects off the ground. So, Tarje, maybe you could kind of give your view there in terms of, yeah.
Sure. Thank you. Our fund, ARM Harriet Infrastructure, is one of the funds that is managing domestic pension fund capital out of Nigeria and international capital out of your typical Mauritius fund. And so we have that experience as well of bringing two sources of capital together to work toward investing in greenfield infrastructure. And so we're quite close to the issues related to mobilizing domestic currency, and have been on this for some time. I think it's important to deconstruct somewhat, though, local capital when it comes to deployment, in that there actually is, as you mentioned, $2 trillion of local capital. So local capital is available. The question is whether it's fit for purpose. And what you find is that the commercial banks are more suited to short-term, higher cost capital provision that's potentially more suited to trading or construction finance. And then the financial sector is more capable of providing long-term allocation, but doesn't have the capacity to move out of the treasury bill allocation into the more complex infrastructure and the like. So there's a lot of work to do around getting these forms of capital into the right places in the capital stack, into the right risk spectrum. And what we find is that credit enhancements are critical. Credit enhancements either to really look at key bottlenecks in that risk spectrum and solve for that bottleneck. And that's where DFIs become crucial. Because to the extent you have DFIs that are able to work potentially with equity funds, so Africa Development Bank is an investor in our fund that gives a lot of comfort to pension funds to be in the equity layer. To the extent that you have DFIs that can provide construction finance takeouts, for example, when you get to operating stage, and then just credit enhancements for risk. I mean, even the placement probably done in Kenya, I'm sure there was a lot of credit enhancements in forms of insurance and credit risk insurance that has to go into all of that structuring. And all of these ingredients have to come together. And to the extent that we identify where there are gaps, not the local currency, but what is the gap to deploying it, that's where it's very crucial for DFIs to play. And I'll close on one point. There is an organization called InfraCredit in Nigeria that is basically a guarantee institution that's been very successful in providing credit enhancement for domestic currency to go into long-term, low-cost provision. And that's really where we need to get to. How do we get long-term, low-cost local currency, and how do we even get to local currency equity?
Yeah. Thierry, it'd be good to bring you in at this point as well, because I think this idea of credit enhancement is not a new idea. It's something that's been around for a while. Yet, as James pointed out, the deficit, the infrastructure deficit is still so huge. I mean, what then are the bottlenecks for you in terms of kind of making that match, to make sure that you have the right credit enhancements in place and that they are, mobilized in a timely manner to get money to work?
Without repeating too much what was said, I mean, before credit enhancement, I think education and expertise is quite critical because it's about understanding the kind of risk that these projects and these investments are actually bringing, and I think that's the biggest hurdle versus getting the credit enhancement. Having said that, I also don't believe that credit enhancement is a magic wand. Because when we see the mismatch of what is available on the local capital, I mean, banks are short-term because banks, they don't really have capital. They are conduits. Pension funds have real long-term capital. And most of the projects that we're talking about require fairly long-term amortization profile and fairly long-term financing to be able to exist. And the mismatch is there. So there's the available capital with people, including local banks that have the expertise, even supported by DFI, to actually understand the risk and take it, they don't necessarily have the funding capacity and the liquidity capacity to lend you for 15 years, but they have it for 5, 6 years, which doesn't quite match your project life, or you face a very huge refinancing risk in a non-existing market, which is a big problem. So I think the credit enhancement obviously should be pursued, but credit enhancement, I mean, if I dare compare the episode of the monolines in Europe, are things that are putting people to sleep because they forget to look at what they're buying. So that's why I'm not a huge fan as saying it's a magic one. It should be very specific and not, I mean, the local capital needs to understand the risk and needs to eventually take it. So credit enhancement can facilitate, but the type of enhancement I think that can help is the type where, for example, DFIs could provide on-lending capacity to actually solve the liquidity, the long-term liquidity issue that is very costly for local banks, rather than necessarily take all the risk. And the local banks could actually take the risk if they have the capacity.
And is that something that the IOC is looking to support in terms of, in terms of what Thierry is asking?
I think that through forms of blended finance, a couple of different ways. One is in some infrastructure projects, if you can tranche the project so that, I mean, coming to the point of some investors are longer-term investors, others are shorter-term. If you can tranche the financing of the project, and we did this with the city of Ekurhuleni in South Africa, and then you can bring in banks and other institutions to fund the shorter tranche, and DFIs can take the longer tranche. So that's one way that you can actually bridge that. You can also use blended finance to, and we've done this in some other places, like in Nigeria and Daystar Power, where we brought in the Canada Renewable Energy program to take on some of the financing, and then we put IFC money in and a IDA private sector window blended finance to allow a portion of the financing to be in local currency and at a lower rate than otherwise would have been obtained, in order to make the financing affordable for the end borrower.
Yeah. I wonder, James, I mean, in your view, how easy is that, given the kind of environment that we're in at the moment, where we're in a high yield environment. I think capital generally isn't flowing to emerging markets as much as it should, as it has in the past. We're in that cycle. So even when you have the right kind of products available, the right strategy available, I mean, how easy is it for you to kind of convince international investors that this is the right project for you, given the current environment that we're in?
So I think where we're getting stuck with capital flows potentially looking for sort of easier entry points than coming to the African market. Like, that's just building the case for we need to solve that through being able to self-fund within the continent. But as far as the enablers go to that, it's going to come down to the DFIs trying to work through many of the things that John's mentioned to try to get these projects off the ground by bringing in the private capital. But I also agree with Thierry's point that this whole concept of the magic wand, or the credit enhancement piece, like, it has a very specific place and should be sitting there for a very limited number of transactions, with a clear view for phasing that out. Because we also run the risk that these projects will forever be predominantly hard currency coming from DFIs, local currency not really taking much risk because they can hide behind that. So we've got to work that down over time.
And that mismatch continues then, yeah. I think, Thierry, did you look like you wanted to say?
It's interesting. I think that credit enhancements, I would like to connect 2 points. I think that credit enhancements can be educative, and that part of the way to get the local pension fund providers or institutions to actually become more familiar with the asset class is to introduce them and give them an opportunity to be exposed to the asset class via a credit enhancement. Because what we've seen in Nigeria is that many of the pension funds who took their first exposures to the infrastructure asset class in a private context 5 years ago did so under a credit wrap, under some sort of DFI intervention. And 3 years later, were able to go in without that wrap. So ultimately, the pension funds are looking for securities. They are looking to solve for a lot of the issues around negative yield, which is, if you think it's bad in the developed markets, imagine how bad it is in developing markets that have even higher inflation levels, and they're struggling with the negative yield. They're trying to look for alternatives. And a credit-enhanced instrument is probably still just giving them, just slightly higher. It's giving them T-bill, effectively. And so they are trying to go more into alternatives. They are looking for alternatives, but the best way for them to take that risk, learn more about the assets, is via credit enhancement. And so indeed, what we're trying to do and what we need in Africa is to scale allocation. We need to scale mobilization, and credit enhancements can be a much needed catalyst for that.
Thierry?
No, I think we all agree. It's just you can't get addicted to it. I think that's it's very good to start things up, but it needs to phase out, or it needs to not become the norm of the market, because otherwise people will not come to the other end of the market. And I think there's also a huge difference, because we're sort of mixing the type of capital here, but there is no issue bringing foreign capital into equity. She's got plenty of it. I've got plenty of it. Because, the real risk in those projects are actually taken by the equity, which is 30-40% of what those projects actually represent in terms of funding. And there is no issue, because those projects are generally, if well structured, very viable. The real issue is the debt portion that needs to be sort of looking forward on a fairly long-term basis, and where the DFIs and the blended finance solutions can help. But the local currency issue, to be honest, and there's been a number of initiatives, either with hedging, which is very costly, either with the risk enhancement, and it does work when, again, we keep referring to pension funds, but this is only a very small portion of Africa that has local pension funds with real capacity. So we're talking about Nigeria, the Kenya, the Southern Cone, but a lot of other places don't yet have these institutions. Sometimes they have European insurers that have local subsidiaries that can do local currency. So it still is lacking quite a lot of this long-term thing on the debt side.
Yeah, what it kind of boils down to, or seemingly boils down to, is just the development of capital markets more broadly, right? So, and that needs a holistic approach, I'd say. But John, maybe a good point to bring you in as well. How do the DFIs support the development of the capital markets to be able to create products that will kind of fill the gaps that Thierry is talking about?
So if I may just make one comment
Please.
on the credit enhancements, and then move to the capital markets. But on credit enhancements, and maybe more broadly on blended finance and ways of de-risking, I think that a core attribute of call it blended finance principles is sustainability beyond a certain period, right? So if a project or ongoing financing has to continue to be at either in credit enhanced or de-risked in other ways, then it doesn't become sustainable, right? And so that's not a very good way to continue to finance something. I was starting earlier with on capital markets. The DFIs are very, very much involved on the policy side, the overall architecture side. I think that some of the additional areas that we've been getting involved in have been on the advisory and the education side. And so an example on the advisory side is to work with local banks to help develop their derivatives capabilities, right? Because if they're going to be able to attract global investors and also to be able to make local currency available, you need derivatives counterparts. And it can be the big international banks, but it's really good if it can be the local banks. And so that derivatives advisory can help them to build up the skill set and so forth to be able to participate in that part of the market.
I mean, we talk about the credit enhancements, there being, I guess, maybe even a temporary measure, right? There's not the magic one that you talk about. The focus on the derivatives markets, all of these seem to be happening. I mean, what do you think needs to be kind of the next step? Does there need to be more of a catalyst? I mean, James, what do you want to see happen next?
I was very vague in my presentation about which country, and I will not name who they are, but if you wanted to come up with a silver bullet, so to speak, as to how you could make this happen, you force it to happen. So there is at least one country that I'm aware of that is looking at, like it's a very risky space to go into, but you could potentially get this right in trying to force a minimum allocation into the infrastructure asset class. So many countries are just at the forefront of that, at looking at will allow something into that space. But if you can show a time horizon of somewhere between 5 and 10 years of you are expected as a fund manager to get to a minimum of X into this particular asset class over time, then that's going to force people to get their head around how you're going to do these transactions and build it up.
Well, I mean, I'll throw it to you guys. Is that realistic, Tarier?
I don't think, I think I would agree there's no silver bullet. And I think it's very difficult to identify a silver bullet because the infrastructure asset class is iterative across the risk spectrum, and there's several bottlenecks. There's not one bottleneck. When you hear all the typical phrases, it's not the lack of capital, it's the lack of bankable projects. It's not the lack of currency, it's the lack of cheap currency. It's not the, so there are so many issues. It's such a multi-dimensional challenge. And what's more important is to basically look at each of these fundamental bottlenecks and to create a framework to address them. And so, ultimately, one of our greatest challenges in Africa is that the infrastructure opportunity is a greenfield opportunity. And creating a financial framework for investing in greenfield infrastructure also requires us to solve problems with early stage investing, early stage project design, project development capital, construction risk finance, long-term, and then equity. And so it's very important that we basically tackle infrastructure as a holistic asset class and then actually create the products that work for each of those bottlenecks or each of those spectrums, and then manage the education process for who's best suited to take that kind of risk.
Yeah, because it kind of feels a little bit contrary to what you're saying. It's depending on the country, but you're saying you have to kind of force it. But I think, Terry, what you're saying is actually there are just so many nuances that things need to be really tailored to specific projects.
I don't think it's contradictory. I think it's complementary. Because
that's a much nicer way of putting it.
She really wants
to. The fact of the matter is, the early stage will not exist if the long-term stage doesn't exist. So the takeout, if it doesn't exist, then you can't do everything. I mean, if I take the example of Chile, who had a huge pension fund industry, and when they started in infrastructure about 15, 20 years ago, they were only taking brownfield operational projects on board, but the local banks will finance the short term and then go refinance with the pension funds. But they were able to sort of commit to those takeouts. So that's what they could do, and now they do everything. And so you need to feed the beast from different angle. The long-term angle is important because this is where the real money is. And that's where the James solutions is quite important to force these institutions to think about it, but to feed them, one of the things that the DFIs could do is also securitize their existing portfolio, which they hate to hear, but slice it, securitize it. It's not a bad word. We can do CLOs, as we can do all these things, and they can actually access securities that are infrastructure and interesting, start to understand how it works long term, and then move forward to the upstream.
James, do you have a point to make? Sorry, John, do you have a point to make there?
Yeah, just to come in on this, I would offer two different programs that actually IFC has, one that is already out there in the market, and another that we're looking at. One is actually the opposite of securitization. It's more like raising a private credit fund. So raising the money ex ante from global institutional investors, and then building a portfolio of emerging market debt, some of which is in infrastructure, but diversified across a range of different sectors and industries, but enabling those investors to, over time, build this diversified portfolio. But I think that a lot of international investors, they lack the data and to be able to do the analysis, to understand the risk-return characteristics. And so bringing them in through this kind of program is a very effective way. We actually announced a $3 billion program that we're trying to raise at COP26 that would be a portfolio that would be completely Paris-aligned. And of course, this is partially in infrastructure. But we also are looking at the other side that Thierry was mentioning on securitizing a portion of the balance sheet. And I think that could be a very effective way of doing it. And it gets to a different group of investors than the ex-ante raising of funds.
Okay. So it sounds like it's all a bit of a work in progress still. We don't have too much long left, but it might be worth going to the audience to see if we have any questions at all. There's one here. And one, can we get a microphone to...
Thank you very much. My name is Zamir Jahangiri. I'm the chair of the infrastructure and energy practice of a firm called Wilkie Farr & Gallagher. I know Thierry quite well. We've been working together for quite a while. I think the elephant in the room is governance and public policy. It's great to talk about financing and the sources of financing that we'd be able to attract for these deals. But one of the things that I, as a practitioner, see is very poor governance from the public sector and very poorly drafted and poorly negotiated documents, which in fact have an impact on the sustainability of these projects. Yep. So what I would actually like to ask the panel is, what do you think? How do you think things are progressing there? There have been a number of initiatives, including the African Legal Support Facility, et cetera. Do you think that's bearing fruit?
Great, thank you. And can we take the second question now as well, and we can tackle them both at the same time?
Hello, my name is Grégoire Krief. I'm working for MSC and Medlog. Concerning the Africanese investment, one of the questions is, I heard that we should also go with the local bank. But the time frame for investment when you go for a local bank is very short. So when you have big project and you look for 20 years investment, 30 years investment, then the banks are not actually helping. So how the connection can be done in between your institutions like IFC and then getting supported by the local banks so we can get enough time to get the funds back.
Perfect, thanks. So the first question on governance and public policy, I think maybe we could speak to our fund manager. So yeah, Thierry, what would you say to that?
Thanks. I think there's been a lot of improvement over the last few years. I think when I started on this journey about 15 years ago, it was very chaotic. Okay. And there's been a lot of targeted support and technical assistance and technocrat development in government to be able to address policy formation, sort of the legal framework for infrastructure. But where I think we have a problem is actually sectoral diversity, in that what you find is that there is a lot more technical capability in, let's say, the energy ministries of finance. From a policy standpoint, the energy sector tends to be more advanced than other infrastructure sectors like transport, waste, and water. And so you'd find that historically about 60% of FDI flows go into energy, and the balance goes into the rest of the infrastructure asset classes, which makes it very difficult.
It's a huge difference, yeah.
So we need more support with providing technical capability into other sectors, especially where government is a counterpart. So you have investable, bankable frameworks for other sectors.
James, did you want to? Sorry.
Yeah.
Sure.
No, I was going to concur, saying that what is also missing is, in a way, a Pan-African ecosystem of experts to do execution.
Okay.
Because, I mean, in a way, policies sometimes are more or less already there, but there's never the execution step. And we've seen improvements. I mean, we actually co-funded this African Infrastructure Fellowship Program just for African civil servants that are in the delivery of projects, whether energy, transport, and things. And we do see that there's a lot of available people in energy. But that today, every year, we receive about 23 or 24 countries from Africa sending people for a 6-month program. But the whole important thing is for them to be in a network together, because what is done in Nigeria can be done in Ghana or whatever. And at the moment, the expertise is always to look outside the region. And it's quite important to sort of go back to, let's share experience and expertise, because now I think there are a lot of successes from South Africa all the way to Egypt, going through everybody. You've had enough examples, so I think that I would push more.
James, you look desperate to say something.
I love what Thierry's doing at the moment, but one of the options that the Africa Development Bank's looking at, when the one point I left completely unanswered was, how do we deal with this drain of capacity on the public sector side, right? That someone does one transaction, all of a sudden you're going and you're now working for that law firm that was on the other side of the table because you have a unique skill set because you've done one deal. So one thing the AFDB is looking at is actually a secondment program from public sector to public sector. So let's say you did an airport transaction in Uganda, and now there's one coming up here. Well, then the Ugandan government would send one of their people across here. So it creates a really interesting sort of career development where you stay public sector side, you're getting fantastic Pan-African experience, and then eventually coming back in with a bit more status. You're now the only public sector person who's done 2 airport deals on the entire continent. But I think where the governance piece is still yet to be tested as thoroughly as what we've seen in the energy space is around a lot of these transport projects in many countries. It is a greenfield space at the moment. What is the public sector's capacity to be an effective counterpart through a 27-year marriage, effectively, that you're getting yourself into? So that's going to need more work while everyone's focusing on the greenfield part of a new project. How do we manage it after construction's done? That's still yet to be seen.
Yeah. It kind of links into the second question, and I know that we touched on that a little bit, but maybe there needs to be a little bit more clarity or information around that, kind of matching up these long-term investment projects with kind of local bank appetite, really. I mean, Thierry, is there anything else
No,
that
I
can
mean,
be done?
I think we did touch on it. First of all, even IFC won't give you 20 years, so. They'll stretch to 18 and then they'll struggle for the last 2. But there's no other solution at the moment that blending and working with the DFIs and the local banks if you want to secure long-term financing. And that's pretty much definite on the continent at the moment.
Did you have anything to add, John?
Well, I think just to echo something that I said earlier, which is if you can structure the project with a maturity transformation element to it where you can tranche it, and you can allow the banks to come in on the early tranches, and you can let the DFIs or other institutional investors who are willing to take the longer term risk can fund the back end of the project. I think that's the effective way of doing it.
I think we might have time for a couple of more questions. Yeah, are there any more? We've got one at the front here.
Hi, everyone. Aubrey Ruby, Tofino Capital, which is early stage investing, but I wear another hat, which is at the Africa Center at the Atlantic Council in Washington. And we've been, hearing of efforts for the last 20 years, as long as I've been in the business at least, of mobilizing U.S. pension funds for investment in African infrastructure. We know that trillions sit in North American pension funds. And so I guess my question is just asking for ideas from this panel on how to do that. There's been efforts to bring the pension funds to the continent to see opportunities. I think we should probably do the reverse, take opportunities directly to them, because there's a huge education gap, there's a misperception of risk, there's all of those things. And I know, Thierry, you've been very successful at mobilizing institutional capital, but on a global platform, the question is how we do that on an Africa-only platform.
Yeah. So Thierry, maybe we go to you first. Yeah, how do you take those
Actually,
ideas?
For Africa, we do it on an African platform. We are very African. Our 40 people team is in Africa, and they're Africans. I wouldn't, without being pessimistic, U.S. pension funds already don't invest in their own infrastructure enough. So the leap to African infrastructure is a big one for them. Where they can start going there is you have a number of very specialized institutions, like the Soros and the foundations and some people who really know how to do real investment, and they can team up with some of the European pension funds that are quite keen, especially the Nordics, on investing in Africa. So that may be a way to make them work together, because, by experience, because we also have a U.S. platform. U.S. pension funds it took them a long time to get into this asset class seriously, and they're still not as serious as other pension fund, whether Asian or European, would be in the infrastructure asset class. So to me, it's really matching them and teaming them with either European or Asian or some sovereign wealth funds that do this very well to come to Africa.
I was going to ask John, is that something that's on the agenda for DFIs, to be able to help mobilize, US pension fund money for African infrastructure? Is that part of this kind of knowledge sharing, education, capacity building agenda?
So the whole area of private capital mobilization is a huge topic for the World Bank Group, IFC, DFIs more generally. So it's not just focused on, say, U.S. pension funds, but I do think that building on some of the things that Thierry was saying, that there's a lot of education that's needed on the side of pension funds, and consultants. There's good data that's needed, because right now they just see the projects as having a lot of risk, and maybe the return isn't there, and it's much easier to just look at a developed market kind of environment to make those investments. So that's on that side. But we also talked about this point on governance and policy. It's really important that there's macroeconomic stability, good governance, good policies in place, so that these funds, they're educated, they learn more about the space, but also the environment in which they're investing becomes more dependable for them.
Okay. Thierry, did you have something to add?
Sure. I think the challenge, there are a couple of challenges with the U.S. pension fund sector. One, as mentioned, is the allocation approach, where the teams that actually do infrastructure allocation are sort of a couple double clicks in to the overarching, alternative system. And so that's one challenge. The other is the point about the fact that America hasn't built greenfield infrastructure in a long time. And so the capital markets, again, are not sort of fit for purpose around greenfield infrastructure and a capital gains investment case for infrastructure. And so what they're more used to is a core case, and their infrastructure for them is an inflation play. And they're basically looking for an inflation hedge. They're not even interested in the asset. Whereas Africa is an asset case. It's investing in a greenfield. It's about building into a de-risked operating class and taking a capital gain. And the American pension funds haven't actually been educated to the construct of why that is actually a high quality risk construct from an equity standpoint, and that ultimately infrastructure still has some juice even when it's operating as compared to developed markets. And it's a very difficult conversation to have because it's a long one, and the way their organizations are structured, it just kind of falls flat eventually.
Well, I think we're nearing the end of our time. I mean, I think we've got maybe 30 seconds each for closing remarks. James, is there anything that you want to leave our audience with? No pressure.
Thank you for letting me go first. Look, no, I think the panel discussion's been great. I love that there's a lot of energy now around. It feels like there's a bit more of a surge into the Africanization of infrastructure, aligning that capital that we've got on the continent as the first priority of getting it into this class, so that we are doing it ourselves, so to speak.
And Taria, any last comment from you?
I think I'd just like to comment that infrastructure is now becoming a much sexier asset class.
Okay.
When I first got into this many years ago, it was kind of that slow sector. And I think the green transition is actually changing a lot of how the global allocation system and even the African allocation system is really looking at the infrastructure. So I think it's a positive time.
Maybe that will be the title for the panel next year on infrastructure, sexy infrastructure, yeah. Thierry?
I'm generally optimistic, and but I think the real push that I would ask is for people to be a bit more motivated. I mean, I think it's true. Infrastructure is a local business. It's for local people, and at the end of the day, if the developers, the local money, and the DFIs don't get a bit too close, a bit closer to the local issues, things won't get going. So I'm also pushing for decentralizing DFI's decisions into Africa versus having it done in Washington, D.C. or Paris or wherever.
Is that right, John? Do you need to get closer to the action?
All right, Thierry. So very soon. This panel topics that and brings a lot of things together. Being more local, education, data, governance, macroeconomic, blended finance. It's not simple. It's not easy. But I think that one can be optimistic that we have more and more of the tools now to make these investments happen.
Brilliant. Well, thank you very much to my panelists today, and thank you to the audience for being here and taking part. So yeah, thank you. Thanks a lot.